Congress just passed the One Big Beautiful Bill, a sweeping tax and spending law that reshapes America's economic playing field. Some of its provisions are set to expire in a few years, while others are permanent, so the impact on your finances could change over time. In this video, I'll walk you through the biggest changes and give you real strategies to build wealth and avoid financial setbacks. The bill makes the Trump-era tax cuts permanent. These tax reductions, which were originally set to expire in 2025, now have no end date unless changed by future legislation. For individuals, this means lower income tax rates, a higher standard deduction. Single taxpayer filers increased from $15,750 to $16,750, and married taxpayer filers increased from $31,500 to $33,500, with inflation adjusted annually, and increased child tax credits will continue. For businesses, the lower corporate tax rate introduced during the Trump era is also locked in, allowing companies to keep more of their profits and potentially invest more in growth and hiring. Cuts to Medicaid, the Supplemental Assistance Program, SNAP, and the Affordable Care Act, better known as Obamacare, subsidies are also permanent with no set expiration date. Tax deductions for tips, overtime, and U.S.-built car loans are now permanent features of the tax code. The SALT cap increase is temporary, and the expanded child and senior tax breaks are permanent. The child tax credit is expanded, but to claim it, your child must have a valid Social Security number. Families without one will not qualify for the credit. These changes add about $3 trillion to the national deficit, with no expiration date for the increased spending. The bill also introduces new permanent taxes on remitting money overseas, so sending funds to family or friends abroad could now cost more. These are not temporary measures. This is a personal finance bill with lasting impacts on your taxes, healthcare, remittances, and future opportunities. In today's ever-changing financial landscape, understanding how to leverage new tax changes can make a significant difference in your yearly budget and long-term financial health. Let's break down some of the most impactful updates and how you can use them to your advantage, starting with the tip and overtime income tax exemption, a game changer for millions of working Americans. It's important to note that some of these benefits are set to expire after the current tax year, while others are ongoing. I'll highlight which is which as we go, and I'll also explain the specifics of the state and local tax, or SALT cap, including the new deduction limit of up to $40,000 for adjusted gross incomes under $500,000. If your household income is under $150,000, you now have a unique opportunity to maximize your take-home pay. Whether you're a server, bartender, rideshare driver, or anyone who regularly receives tips, both cash and electronic, tracking every dollar is more important than ever. Don't leave money on the table by underreporting or forgetting to log your tips. Make it a habit to record your daily earnings, no matter how small, and keep a running tally throughout the year. This not only helps you claim the exemption, but also gives you a clearer picture of your true income, which is essential for budgeting and planning. Keep in mind, the tip and overtime income tax exemption is currently set to expire at the end of the 2028 tax year unless extended by Congress, so take advantage while it lasts. To make this process easier, consider using a free app like Grid Money or QuickBooks Self-Employed. These tools are designed to help you log your tips and other variable income streams quickly and accurately. With features like daily reminders, automatic categorization, and easy export options for tax time, you'll save hours of stress and avoid costly mistakes. Even if you're not tech-savvy, most of these apps are user-friendly and offer tutorials to get you started. Remember, the more organized you are, the more likely you are to benefit from every available tax break, especially while the current exemptions are in effect. When tax season arrives, filing accurately is crucial. Double-check your records, ensure all your tip and overtime income is properly documented, and claim the exemption on your return. If you're unsure about the process, don't hesitate to consult a tax professional or use reputable tax software. The IRS is making it easier to claim these exemptions, but accuracy is key to avoiding audits or delays in your refund. By staying diligent, you can keep more of your hard-earned money and reduce your overall tax burden, at least while these temporary provisions are available. Over time, pay is another area where you can benefit. If you're putting in extra hours at work, make sure to track those as well. Overtime counts toward the exemption, so every additional hour you work could mean more money in your pocket at tax time. Save your pay stubs, keep digital copies, and note any discrepancies immediately. This is especially important for shift workers, healthcare professionals, and anyone whose schedule varies week to week. By being proactive, you'll ensure you don't miss out on valuable deductions. Now, let's talk about a major opportunity for those considering a new vehicle purchase: buying a US-built car with a tax-deductible loan. This new provision allows you to deduct up to $10,000 per year in interest paid on loans for eligible vehicles. There are also adjusted gross income limitations. That's a substantial savings, especially if you're financing a car for personal or business use. Not only does this help lower your taxable income, but it also makes owning a reliable vehicle more affordable. This deduction is currently scheduled to expire in tax year 2028, unless further extended or changed by new legislation. To take full advantage, review your financing options carefully. Compare interest rates, loan terms, and make sure the vehicle you're considering qualifies as US-built. Eligible brands include Ford, Chevy, and Tesla, but always check the vehicle identification number, VIN, to confirm its origin. The deduction applies if you're buying new vehicles only. This is a great time to negotiate with dealerships, as many are offering incentives to move inventory. When shopping, look for vehicles that not only qualify for the deduction, but also offer long-term value. Fuel efficiency, reliability, and resale value should all factor into your decision. For example, a hybrid or electric model can save you money on gas and maintenance, while also qualifying for additional state or federal incentives. Don't forget to inspect the detail sticker and verify the VIN's country of origin. This small step can make a big difference in your tax savings. Here's a smart strategy. Purchase a fuel-efficient US-built vehicle, deduct the loan interest, and use the car for gig work like Uber, Lyft, or Instacart. This not only helps you offset the cost of the vehicle, but also creates an additional income stream. Many gig workers find that the combination of tax deductions and extra earnings can significantly boost their financial stability. Keep detailed records of your mileage, expenses, and income from gig work to maximize your deductions and stay compliant with IRS rules. Families and seniors can also benefit from increased deductions this year. The expanded child and senior deductions mean more money stays in your pocket. If you have dependents or care for an elderly family member, make sure you're claiming every eligible credit and deduction. These changes are part of a multi-year expansion and are currently scheduled to expire at the end of tax year 2028, but could be subject to change depending on future legislation. One simple but effective move is to update your W-4 form at work. By adjusting your tax withholding, you can reduce the amount taken out of each paycheck, freeing up cash for immediate needs or investments. Many people over-withhold and end up with large refunds, but that's essentially giving the government an interest-free loan. Instead, put that money to work for you throughout the year. This strategy is always available and not subject to expiration. With the extra funds from reduced withholding, consider paying down high-interest debt, which can save you hundreds or even thousands in interest over time. Alternatively, start or increase contributions to a Roth IRA for tax-free retirement growth, or open a 529 plan to save for your child's education. These small changes can have a big impact on your financial future, helping you build wealth and security for yourself and your family. Homeowners, take note. The state and local tax, SALT cap, has been raised, now allowing you to deduct up to $40,000 in state and local taxes if adjusted gross income is under $500,000. This is especially valuable for those living in high-tax states or areas with rising property values. Review your property tax bills, mortgage statements, and local assessments to ensure you're capturing every possible deduction. The increased SALT cap is a temporary measure. In 2030, the deduction cap reverts back to $10,000. If you're itemizing deductions, work with a tax advisor or use advanced tax software to make sure you're maximizing your property and local tax deductions. Keep organized records of all payments, and don't overlook smaller local taxes that may also be deductible. Every dollar you deduct reduces your taxable income and can lead to significant savings at tax time. Here's a powerful strategy for homeowners. Use the savings from increased deductions to make an extra mortgage payment each year. By doing this, you can cut years off your loan, save thousands in interest, and build equity faster. Even one additional payment annually can make a noticeable difference over the life of your mortgage. Review your budget, set up automatic transfers if possible, and watch your progress toward financial freedom accelerate. This is an ongoing strategy you can use every year, regardless of tax law changes. By staying informed and proactive, you can turn recent tax changes into real financial advantages. Now, let's take a closer look at one of the most valuable updates for older Americans, the senior tax deduction. If you or a loved one is age 65 or older, this new provision could mean extra savings at tax time. So, what exactly is the senior tax deduction? Simply put, it's an additional standard deduction available to taxpayers who meet the age and income requirements. Qualifying seniors can claim an extra $6,000 on top of the regular standard deduction and up to $12,000 for joint filers where both spouses are 65 plus. No deduction once adjusted gross income exceeds $175,000 for a single filer or $250,000 for joint filers. There are no special forms required. The deduction is automatically applied if you use the standard deduction. This means you don't have to itemize or track extra paperwork to take advantage. What are the benefits? For many seniors living on fixed incomes, this extra relief can help stretch retirement savings further, covering essentials like groceries, medication, or utility bills. The senior tax deduction is currently scheduled to be available through tax year 2028. Up next, let's talk about protecting your healthcare in uncertain times. The bill reduces federal Medicaid funding by approximately $800 billion to $930 billion over 10 years, leading to an estimated 7.8 million to 11.8 million more uninsured by 2034. Starting January 1, 2026, automatic enrollment in the Affordable Care Act (ACA) marketplace plans is discontinued. Previously, over 11 million people were automatically re-enrolled each year. Able-bodied adults, especially parents with children over 14, must complete 80 hours per month of work, training, volunteering, or schooling, with states performing frequent verifications. It also limits access for non-citizens and undocumented immigrants. Medicare will face about $490 billion in reductions, approximately 4% annually, starting in 2026, potentially cutting provider payments and raising patient costs. Eligibility is explicitly limited to U.S. citizens and lawful residents. Undocumented immigrants are barred. Use healthcare.gov or your state's marketplace to compare. Open enrollment periods do have expiration dates each year, so be sure to check deadlines. Consider a health savings account, or HSA, tax-free contributions, tax-free withdrawals for medical use, and you can invest in the HSA long-term for retirement healthcare needs. HSAs are a permanent option as long as you have a qualifying high-deductible health plan. If you suspect you'll lose Medicaid or subsidies, apply for coverage early. Medicaid eligibility and subsidies can change, so act before your current coverage expires. Use a local navigator, like through United Way or 211.org, to avoid penalties. Assistance is available year-round, but some enrollment windows do expire, so don't wait. As SNAP benefits are reduced or delayed, it's more important than ever to be proactive about your food budget. Able-bodied adults must complete 80 hours per month of work, training, volunteering, or schooling. This applies to parents with children older than 15, not just those without children. Youth exiting foster care as young as 18 must show work, training, or school to receive benefits beyond 3 months. Effective December 31st, 2026, after which states must enforce these across-the-board requirements. States are required to verify compliance monthly or during each redetermination period, increasing administrative burden. At this time, there is no set expiration date for these SNAP cuts. Many of the changes are either indefinite or could become permanent, depending on future legislation and funding. That means it's wise to prepare as if these reductions could last for the foreseeable future. Start by sitting down with your family or household members to create a detailed meal plan for the week. Planning meals in advance helps you make the most of what you already have, reduces the temptation to buy unnecessary items, and ensures that nothing goes to waste. Take inventory of your pantry, fridge, and freezer before making your grocery list, so you can use up ingredients you already own. This not only saves money, but also helps prevent food spoilage and waste. Use technology to your advantage. Download grocery savings apps like Flip, which lets you browse weekly ads and digital coupons from multiple stores in your area. These apps can help you compare prices, find the best deals, and even build your shopping list directly from the sales. Many stores also have their own loyalty programs or digital coupons, so be sure to sign up and check for extra savings before you shop. Cooking in bulk is another great way to stretch your food dollars. Prepare large batches of soups, stews, casseroles, or pasta dishes, and portion them into containers to freeze for later. This not only saves time on busy days, but also ensures you always have a homemade meal ready to go, reducing the temptation to order takeout or buy convenience foods, which are often more expensive. Consider shifting your grocery shopping to discount grocers like Aldi, Lidl, or Costco, where you can often find staple items at lower prices. Buying in bulk can be especially cost-effective for non-perishable items like rice, beans, pasta, and canned goods. When you get home, start a pantry reserve by setting aside a small supply of these essentials. This reserve can help you get through weeks when your SNAP benefits are delayed or reduced, and it provides peace of mind knowing you have a backup. Review your household budget regularly to see where you can cut back or reallocate funds. If you anticipate a reduction in SNAP benefits, try to set aside a small emergency fund specifically for groceries. Don't hesitate to sign up for local food banks, churches, or nonprofit organizations that provide food assistance. These resources are there to help during tough times, and many offer fresh produce, dairy, and protein in addition to shelf-stable goods. Some programs even deliver food directly to your home if you have mobility challenges or lack transportation. To find food assistance programs in your area, visit websites like feedingamerica.org or findhelp.org. These sites let you search by zip code for food pantries, meal programs, and other support services. You can also call your local United Way or the 211 hotline for personalized help connecting to resources. Whenever you earn cashback or rewards, consider putting that money directly into your emergency fund or using it to pay down debt. Building a small financial cushion can help you weather future SNAP cuts or other unexpected expenses, giving you more stability and peace of mind as you navigate these challenging times. In today's economy, rising government deficits can lead to inflation and higher interest rates, eroding your savings value. That's why it's crucial to have a plan that can weather economic storms and protect your purchasing power. Maximize tax-advantaged accounts like your 401k, IRA, or health savings account, HSA. These accounts let your investments grow without annual taxes, accelerating your path to financial independence. Stay informed. Subscribe to 2 or 3 trusted finance channels. Staying updated is always important. Sign up for tax policy alerts on irs.gov. Watch your state's Medicaid and SNAP decisions, since they may vary. These programs can change, so their protections are not always permanent. Review them regularly. Be debt aware. This bill may be beautiful to some and brutal to others, but how you respond determines your financial outcome. Use these strategies to cut your taxes, protect your income, and build long-term security. Hit that like button if you learned something new, and drop your financial question below. We may feature it in a future video. Don't forget to subscribe to Building Wealth Today TV, where we turn policy into power.